Can we all agree, because of how the world is set up, because it's round or whatever, we have what we call different time zones. So in some parts of the world, it's already tomorrow. And in other parts of the world, it's still yesterday. And for that reason, because Forex is a global market, the Forex market is open 24 hours a day. And we have what we call different Forex sessions. And in today's video, I'm going to tell you every single thing you need to know about these sessions. And I'm going to tell you the very best times to trade. So if you like the sound of that, go ahead and hit the little like button, because apparently there's this thing called the YouTube algorithm, and I have no idea how it works, but I've heard rumors if you hit like, it should spread the video around, get the channel to more people, and it'll help the channel grow, and it'll make me feel all warm and fuzzy inside. So if you can, do me a favor, help me out, give the little like button a quick little love tap, and we'll get started with the video. Okay, first thing, Forex open 24 hours a day, 5 days a week. Traders need weekends off to party and enjoy some of that Colombian kebab. Bonus points if you got that joke. So the Forex market closes for the weekend for every single person in the world at the same exact time, at the same exact second. And that time is 5 o'clock Eastern every Friday. So depending on where you live, you need to convert 5 o'clock Eastern to your time zone, and it stays closed the rest of Friday, and the market stays closed all of Saturday, and the market stays closed Sunday until 5 p.m. Eastern on Sunday. So depending on whatever your time zone is, you would convert 5 o'clock Eastern Sunday, 5 p.m. to your time zone. And then from the rest of the Sunday night, Monday, Tuesday, Wednesday, Thursday, Friday, it remains open. So now that we got the basics out of the way, we need to talk about the different Forex sessions. So the current currency pair that I'm looking at right now, you'll notice it's the Euro USD. We're comparing the Euro versus the US dollar. And we're going to be talking a lot about this little timeline at the bottom here. So we'll be talking about this a lot. So make sure you pay attention to this little area right here. You'll notice I'm looking at what's called the 1 hour time frame. Each little candle that you see is just representing 1 hour of time. And if you look at this little time frame, you'll notice every time I move the mouse a little bit, it's going by 1 hour, starting from midnight, 1, 2, 3, 4, 5, 6, 7 a.m., 9 a.m., and going all the way up to the 23rd hour and back to the 24th hour throughout the whole 24-hour session. Now, this 24-hour block is actually split up in between different sessions based on what side of the world is running their standard business hours. And let me kind of give you an easy visual representation so you can understand when these sessions are in play. So a very easy way to kind of look at it is I'm using right now what's called TradingView. This is a trading software. There's a link in the description to pull up the same exact screen so you can pull up the software as well. This is completely free software. You can sign up if you want, but in this software, in TradingView, if you go to the little indicators section, you can overlay a completely free indicator, which allows you to see the different sessions. So that's what I'm going to do now. So I'm just going to search sessions, and you'll notice there's all these different indicators in the public library that all these random people kindly made for us.
I appreciate you.
And I'm just going to click on the most popular one because, hey, why not? And if you click on it, you'll notice it'll just overlay what's called these different sessions. Now, I'm going to get out of the 1 hour time frame. I'm going to dive deeper into what's called like the 10-minute time frame so we can look at these a little bit closer, get a little zoomed in view of the sessions. So right now, we are currently in what's called the Tokyo session. And let me just pull up this little settings cog toolbar so you can kind of see how this indicator works. So I'm just going to open this up and show you there are 4 sessions in the Forex market. There's one called the London session, the New York session, Tokyo session, and the Sydney session. And you'll notice the Sydney session by default is unchecked because most traders, we really don't take the Sydney session into consideration. We mostly trade what's called the London, New York, or Tokyo session. And to kind of help you understand which session is which, I'm just going to uncheck and recheck it, and you'll notice which ones are being highlighted. So I'm going to uncheck the Tokyo. You'll notice the yellow disappears and shows back up. And the New York session, which is the red one, it disappears and shows back up, and then the London session, which is the green one, right? And one thing you'll notice that these three colors, yellow, green, and red, you'll notice at times they overlap. So just to kind of explain how this works is, let's go ahead and start with the Tokyo session. The Tokyo session opens up where I live in Dallas right now in Texas. It opens up at 19 o'clock. What is that? Is that 7 p.m.? So that's 7 p.m. when that starts, because in their time zone, this is morning for them. And then their time zone, their session runs all the way up until the end of the overlap right over here, which is around 3 a.m. for me in Texas, where I live, Central Time Zone. And the London session, notice where the green starts, this session opens up at around 2 a.m. where I live in Dallas, in Texas. And it runs until where the overlap ends around 11 a.m. And the New York session runs at normal business hours here in the US, or in other words, like the Eastern Time Zone in New York. This session runs around 7 a.m. Texas time, Central Time, which would be 8 a.m. Eastern Time. And this session ends at 4 p.m. Central, which is 5 p.m. Eastern. So this would be like a normal 8 a.m. to 5 p.m. normal business hour shift, right? Which is why this is when the session is active. And you'll notice at times the two sessions overlap each other. Now, I want you to think about something. When the US session is running, that means businesses are working, the government's churning, everything is open, and it's morning time, afternoon time. It's the day shift for everyone in the US, which means the traders in the US are most active at this time. This is mostly when the US traders are trading. Now, thinking about this time frame, the London session, this is their morning. This is their like 8 a.m. all the way to their 5 p.m. So this is when these traders are trading. So the question you have to ask yourself, just thinking about it logically, at which time are the most amount of people trading? It is at a time where these two sessions are overlapping. And the same thing here. In this small sliver of time, this is when many traders are trading, because Tokyo's also trading and London's trading at the same exact time. So there's a lot of activity happening in this time frame and a lot of activity happening in this time frame. And as traders, we want to trade when there's a lot of activity. As traders, we like volatility. We like when the price dramatically moves up and down. It's because if we are accurate in our analysis, in our trade, we'll make money all the way up or all the way down if we're accurate in our analysis. So we don't want to trade when the market isn't moving that much or when the market isn't moving at all. We want to move when the market is dramatically moving, because that's the different opportunities that allow us to make the most amount of money. And based on historical trends, and I don't want you to take my word for it, I literally want you guys to do your own research, and I don't want you guys to go ahead and apply this same indicator to your chart and like look at it yourself. Now, based on historical trends, the session that has the most amount of volatility, the session that has the most amount of people trading at the same exact time is, believe it or not, it's the London session. This is usually the session that has the most amount of traders trading at the same exact time. And it's because London is one of the biggest sections of the world that trade the Forex market. And you'll even notice that the London session is overlapping with the Tokyo session, and it's overlapping with the US session. So it has all three sessions that are kind of overlapping, which gives it a lot of volatility. So number one, it's the London session. The second most biggest session would be the US session. So this has like the second highest terms of volatility and movement and people participating in the market in this amount of time. And matter of fact, I think around 90% of Forex trades are traded with the US dollar currency pair. So it's either like people trading the Euro US dollar or the US dollar Japanese yen, or the GBP US dollar, right? Something that has the US dollar in it, those are usually the most popular currency pairs that most people generally trade. Now, the third most popular session would be the Tokyo session. It usually doesn't have as much volatility as the other two sessions because there's not as many players trading at the same time. Now, the fourth most popular session, or the least popular session, is usually the Sydney session, which generally does not have as much volatility. So if you guys kind of see what's happening here, as soon as the US session finishes, the Sydney session starts. So usually right at around 5 p.m. Eastern is usually whenever traders just kind of chill out and really don't input many trades because there's usually not a lot of volatility. And the spreads usually at this time are wider. I'm not going to go into a lot about spreads, but I have uploaded like a previous video that talks about it. I'll link it right up here if you want to watch that video. But knowing these things about the volatility and the amount of players that participate in certain amount of sessions will kind of help you determine, so you can think to yourself, which session is probably the best for you. So whenever you're looking to trade, most traders look at this little gap, and they usually don't trade this little gap too much at this different time point, simply because the markets generally don't move that much at this time. I'll just go back a little bit in history so you can kind of see the price generally doesn't move too much. So if you wanted to input a trade, let's just say you did input a trade here, and you traded during the session and you closed your trade here, throughout this whole time frame, throughout these 3 hours, the price only moved around 15 pips. So you would have been just sitting there with your hand in your pockets, just really not doing anything. So now, knowing which session usually has the most amount of market participants and looking at which currency you're actually trading will help you determine which time frame that you should generally want to trade. So for example, we are currently looking at the Euro USD. I want you to think about, in terms of the world, in terms of the economy, which countries are turning, which countries are conducting business when it comes to this currency pair. We're talking about Euro and the US dollar. So the US dollar, we would be focusing on this time frame, the US session, and we would be also focusing on the London session, which is when Euro is conducting business. So right over here as well. So the time frames that traders would want to focus on would be the time frame from here all the way to here, generally when this pair would have the most movement. So what causes the volatility? What causes the price to actually move up and down in these time frames? So what happens is, when these countries are running their businesses, the European Central Bank, in terms of the euro, their central bank is conducting monetary policies. They're putting out speeches. They're releasing different numbers for their economy, different GDP factors. And when the US session is running, the US dollar is being moved up and down because the Federal Reserve, the United States Central Bank, they're releasing their numbers. They're releasing their different economy. They're talking about their monetary policy, whether they want to increase or decrease the interest rate to fight or help with inflation. And the NASDAQ, the stock market, can definitely also affect what's happening with the US dollar as well. If the stock market is going down, the US dollar will instantly get affected, which will cause this currency pair to instantly make drastic moves as well. And these central banks, they're always coming out with a bunch of news-driven events that allow this currency pair to move. And these news events aren't what are causing the price to actually move. It is actually traders' opinions about what they feel is the valuation of the currency, which is allowing the price to move up and down. Because if a news event comes out and it's good news for the euro, and traders see that some very good news came out, they would think to themselves, okay, good news came out, so I feel that the currency is going to go up, so let me go ahead and buy low. Because good news came out. I feel like the economy is getting stronger, so I could eventually later on sell high. buy low, sell high. And again, if enough people, if enough smart money has that same type of opinion, same type of thought process, everyone's buying, which is just pushing the price up and up and up and up and up, because the demand is increasing. The demand is increasing, which causes the price to go up, and traders will then close their positions whenever they're satisfied with the amount of fluctuation that the currency exchange rate has fluctuated. So we need to take the same exact concept of whatever session is running based on whichever currency pair we're looking at. We have to use the same type of concept, the same type of thinking for other currency pairs. So let's just take into consideration the US dollar, Japanese yen, for example. We have to think about which sessions generally have the most amount of business being conducted. That's going to be this yellow one, which is when the Japan market is conducting their business, and the US dollar, the red one or the pink one, which is when they're generally conducting their business. So when we take a look at GBP JPY, which is the Great Britain pound versus the Japanese yen, we need to ask ourselves which sessions are generally being run for this specific currency pair. It would be the Japan session as well as the Euro session, the London session, the GBP session. So it'd be the yellow and the green session that generally have the most amount of business being conducted, which causes the most amount of volatility in this specific currency pair. So if you want to catch the biggest swings for GBP JPY, most traders would look at what's happening in between from here all the way to up here, these two sessions. Why? Because this is when they're running their businesses. This is when their business operating hours are actually being run. So when is the best time to be able to trade the Forex market? There's a few things you need to take into consideration. Number one, we need to understand and take into consideration which sessions generally have the most amount of market participants. And that's usually the London session. And coming in second place, that's the US session. And coming in third place, that's the Tokyo session. And fourth, that is going to be the Sydney session. And the second thing we have to take into consideration, which markets, based on whichever currency pair that you're looking at, which markets are actually running their businesses during their normal business hours. So it'll depend on each various different currency pair, because you'll be able to look at any different news events that come out for that currency, and that'll allow the fluctuation for the price to move up and down dramatically if there is good or bad news coming out. So based on where you live in the world, some currency pairs might be better for you to trade, and other currency pairs might not be as ideal for you to trade. So you need to look for a mix between, a different balance between the different times based on the currency pair and the amount of volatility the currency pair gives you. I'll give you an example. Euro USD and USD JPY generally aren't as volatile. They usually move the least. So if you're looking for a currency pair that has a little bit more volatility, you might want to look at other currency pairs so you can make more pips in the movement up and down. So I hope this video was able to give you some insight on how the market moves up and down based on the session and based on the different currency pairs. And I definitely encourage you guys to go ahead and enable this indicator and just play around with it and just kind of see how the market moves based on the session that you're currently in. So that is all for this video, and I'll catch you guys in the next one.